Hey everyone, welcome to the final bar. Today we're going to talk about a market continue to showing signs of resilience as the S&P starts in the negative but recovers, sort of finishes more flat for the day, net positive. We're going to dig into the market from three different directions today. It's my favorite part of Mondays: top-down macro, bottom-up stock selection, sector rotation in the middle. Some fascinating sector themes emerging, as well as a number of stocks at key points, which we'll highlight later in the show. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at today's price action, to try and make sense of things from a technical perspective, connect the short term of today with the long-term trends. And Mondays, as I mentioned, my favorite day to hit the market from three directions. And my wife actually was asking me about why I keep pounding the table on these three directions on Mondays. And it's, I think when you're approaching investing, you have three decisions to make as an equity investor for sure. Top down, where am I allocated? Middle, sector level, based on my macro perspective, what sectors am I going to overweight or underweight, or where am I going to look for opportunities? And then the final step is what stocks, what ETFs, what specific securities am I going to put in my portfolio? And that process is an iterative process that I think a knowledgeable investor is going to continue to go through. So hopefully these Monday shows where we go through this, very quickly through each of these steps, I hope it helps you think about your own process and where you might be able to upgrade things using the power of StockCharts.com. Let's get to some of the guests we have on StockCharts TV. Again, I feel so blessed that we're able to bring on some very knowledgeable people onto the show and onto the channel for you. This week is a fantastic one. Earlier today, we had our latest episode of Behind the Charts. That's our interview-style show, and it featured a conversation with Keith Fitzgerald, who's a fellow Washingtonian, and a really cool conversation talking about his approach to investing, in particular about mental states and how you approach the mental game of trading, mental game of investing. So worth watching if you missed it earlier today on our YouTube channel. Later this week, tomorrow, we have Roman Bogomazov. Roman's a longtime friend down in the San Francisco Bay Area, an expert in Wyckoff analytics, Wyckoff analysis. On Wednesday, we have Sam Stovall from CFRA, fantastic equity strategist. And then on Thursday, a familiar name and face to many of you, Tom Boley from Earnings Beats, a longtime StockCharts contributor, going to give us his take on the market. And also on Wednesday, I was just talking with Grayson Rose earlier today. Grayson's going to host our next episode of The Pitch. This is one of our newest shows where we feature a StockCharts moderator and three guest panelists to pitch you their ideas, to pitch you using charts, and then we'll have a conversation as a group. And it's a really cool show and a very well-received platform to give you new ideas. So join us on Wednesday for that one, The Pitch. Let's get to our market recap. We've got a lot of movement today. It's so funny. The S&P ended up being very volatile, but settled back right almost to the zero line. Just before I did the introduction, I tried to glance over to see where we finished things off. It was almost exactly flat right at 2930 for the S&P. We actually asked you guys a poll recently or the last week. Which outcome do you think is most likely for stocks over the next month or two? 45% of you said a retest of the March lows would put the S&P down to 2300. Form some sort of square root symbol. A third of you responded that answer. And then the third option, least popular, but still 21% of the vote, was continue the V-bottom recovery. So 1 in 5 of you said this V-bottom continues. The S&P continues to, make this V pattern to go higher. A third of you said some sort of square root symbol. And I actually took that from a conversation with Craig Johnson last week, if I remember right, where we talked about sort of that square root signal, right? The big rally, and then more of a sideways back and fill sort of period as we find an equilibrium. And then some of you, 45% actually said you would retest the March lows. That's a really interesting response. I was actually surprised to see almost half of you still thinking we would retest the March lows, and that's after the strength that we've seen. If I didn't vote in this one, if I remember right, if I did, I would vote. I would say retest the March lows, to be honest with you, only because I am finding that's less and less. It's more and more of an out of consensus answer. If you look at investment strategists, a lot of them have been talking about, a retest. But as the market has rallied, I feel like less and less people are willing to say that the S&P is going to get down in the 2,300, 2,200 range. It just seems ridiculous now, just as ridiculous as current levels looked probably 6 weeks ago when we're down here around 2,200. But having said that, again, for me, it's the characteristics of the bear market rally that have followed through so well, right? You've just had this pattern that lines up with historical bear market phases. But again, as always, the proof is in the pudding. The number one thing to watch is the chart of the S&P 500. I think that's the main idea, right? And so, whether or not you think something should happen, and thank you everyone for answering the poll. Hopefully what you get out of this show is, I think the most important thing is not what you think should happen. You need to look at what it actually is happening. Follow the trends, follow the movements, and follow what's happening with the charts. And I think more often than not, you're going to be on the right side of things. So let's use that as a context of where we're seeing, right? We've had this V bottom, undeniable. We are right at that sweet spot, 61.8% of the retracement level. And again, regardless of where you think things headed, let's talk about what happened today. The S&P finishing flat, mid caps and small caps actually down a little more. So, as I was going through the charts on Friday, during Friday's show, we do our wrap the week segment, I noticed you're starting to get more and more participation from mid caps and small caps. And a number of days last week, you actually had mid and small caps leading mega caps, which is a little different, right? We've had this rally, which has really, in a lot of ways, been driven by the mega cap trade, right? And if you look at the February peak to where we're at now, mega caps, large caps have certainly outperformed any other slice of the pie. But if you look from the March lows, mid caps have actually been number one. But the more days that you see like today, where you see small and mid caps down with the S&P flat, that shows you more of a safety trade. And if you look at the sector rotation, you can see it's healthcare and technology. Those are the two sectors that finished in the positive. Everything else was flat to down today. The biggest losers, financials, energy, materials, industrials, and some of the defensive real estate and utilities really sort of flat. So financials really leading the way down, healthcare really leading the way higher, and healthcare and tech really the two sectors getting it done today. It's interesting, as we rotate into our next segment on sector setups, we're going to focus in particular on these two top sectors, healthcare and tech, and just look at what the charts are telling us about potential rotations. Looking at the rest of the movements today, a lot of things in a real positive shape. Biotech stocks continue to be in a position of strength. We've looked at the biotech individual charts, and if you look at, there's so many. Regeneron, Vertex, VRTX, a number of others come to mind, right? Or just the BTK, the broad biotech index. It's just been in a position of strength, continues to do well, and that's in a lot of ways obviously a coronavirus play, and betting on them benefiting from the challenges we're facing. If you look at the top 10 sectors, it's sort of that theme. It's biotech, medical supplies, pharma, medical equipment. Within tech, it's hardware, software, drug retailers. So it's sort of this, stay-at-home recovering thing. This is not retail stocks are at the top here. This is not a vote of confidence of, the world reopening very quickly, and those are the companies that are going to benefit. Look at it, apparel retailers. They're getting absolutely brutalized right now. So I don't think it's, when the market is up and we see this quote unquote V bottom, let's be careful about what's actually leading the way. When you look at the bottom, you see a lot of these things that should be struggling in a sustained, wait and see mode for the economy. Hotels, furnishings, REITs tied to retail, mortgage REITs, airlines, gambling stocks. So it's sort of today was certainly a move back toward the coronavirus safety trade of the healthcare and tech that's going to keep things going, so we can do fantastic Zoom calls that we're all doing more frequently than we ever imagined. And the, everything's better, the economy is reopening tomorrow trade, certainly not getting a bid. And again, just for today, but some of those groups down fairly significantly in one day of movement. We're going to get to individual stocks in a little bit. I did want to point out that we have a new number one stock with our StockCharts technical rating, our scooter rankings. It's Fortinet. We'll come back to that if we have time. We probably won't, so let's just get it really quickly. FTNT is one of the software names. We're going to look at some other ones, but if you look, this is one that actually gapped up. Again, we got heavy earnings, so we have a lot of stocks gapping up and down, which is creating plenty of volatility. This is one that has gone now to a new 52-week high, continued up another 2.5%+ today. at a time when the S&P was flat. Worth noting, this is one of the few stocks that's nearing an extreme overbought condition with an RSI above 80. We used to see that a lot at the beginning of the year, have not seen that very often up until now. Let's go into our next segment, which is sector setup. So what we love to do is look at sector rotation at a top level and then sort of go through some different themes. After that, we like to start with the RRG, the relative rotation graph. Again, look at my colleague Julius de Kempener's work. If you're not familiar with that, either go to Chart School or articles on RRG or watch his show, Sector Spotlight. Does a really good job of explaining this methodology. But I've used it for a number of years as a way of visualizing the 11 S&P sectors around the S&P at the crosshairs, right at the zero line. I look at the longer term version, which is a weekly version. Again, this is not a timing tool for me, but it's more of a way of visualizing how things are rotating, what's emerging in a position of strength, what is struggling a little bit. What's interesting here is technology had been the #1 sector for months and months. I feel like since we first launched this show, a while back, technology appeared to be in that position of strength, far right side. This was last fall. Since then, it started to rotate lower, and healthcare really overtook it, and staples very close behind, emerging as the new leadership, right? What's happened, though, is you see the XLV healthcare rotating down, consumer staples now heading southwest. If you look at the relative performance of consumer staples, even just over the last 6 weeks, even though there are some stocks in there still doing okay, and there are stocks holding up pretty well, like General Mills comes to mind, Hormel, Campbell Soup, right? Some of those sort of coronavirus staples names are doing okay, but on average, the average consumer staple stock is starting to hurt, especially on a relative basis, and that's what's making this sector sort of rotate southwest, which is not the position of constructive price behavior. The XLK literally did a pivot, and instead of going into the weakening quadrant, which it teased doing over the last couple of weeks, it has now pivoted very quickly, gone northeast again. This is as Microsoft and Fortinet and all these other technology names are just continuing to outperform. And that sector has been so resilient. Again, as I think about equity position and sector allocation, if you're not considering technology as a sort of a quote unquote core position, a core methodology, a basic trend following strong position, I'm not sure what you're using, because by any measure I would look at in terms of strong trends, I think the XLK is pretty much doing it. And a lot of the names, Microsoft, Apple, and everything below there seem to certainly be following through there. We're going to look at a couple technology names later in the show. What else has rotated weaker? Utilities and real estate. These had been two dominating defensive sectors that have now rotated back down. Again, that's I guess a byproduct of the sort of risk-on trade that's emerged, this V bottom that's occurred. These sectors that were starting to outperform, starting to hurt a little bit. Communication services actually starting to improve, and again, it's a mixed bag of stocks in there. You have things like Facebook and Netflix and others that are really starting to do fairly well. Consumer discretionary actually now back in the leading quadrant as well. So if you look at the 5 sectors up here, the 2 or the 3 that are emerging northeast are tech, communication services, consumer discretionary. The 2 that are still relatively strong but pulling back just a touch, healthcare and staples. The ones that are really getting destroyed are utilities and real estate. And then energy is still sort of a void based on this methodology, just because it's so far away and such a consistent laggard over the long term. Industrials and financials continue to rotate to the southwest. And again, it's just not, financials have some of the worst breakdowns around, although there are some random bright spots, which we'll get to momentarily. One of the things I just wanted to point out as we think about sector rotation, then we're going to look at a couple individual sector charts to wrap up here, is just looking at some different slices of time. And one in particular I was looking at was just the last 3 or 4 weeks. So I started the clock in mid-April. This is the relative return. So I'm using the perf chart, which basically means you can put in a group of symbols, You can click on one of the tickers, which normalizes them all to the returns of that specific thing. So if we look at the absolute returns, you can see the S&P was up 5.3% since April 15th. Energy, the #1 sector, up 21%. By clicking on the sector spiders up here in the legend, I'm now basically setting the S&P at 0, and I'm looking at the relative performance over that time period, last 18 trading days relative to the S&P. So energy, certainly the strongest place. You can see about half the sectors have outperformed. This is just looking at the last 3 weeks, and I'll show you some of the charts in a minute to tell you why I picked that slice of time. But if you look, the things that are working are the things that are looking pretty good for the most part on the RRG: discretionary, communication services, technology. Those are the 3 heading northeast. So not a surprise that those are the threes that have outperformed pretty well. Materials also doing pretty well. That might be the 4th place. using the methodology. Energy has certainly been the #1 sector on a relative return basis. But again, they're coming out of such severe beaten down levels where something like tech, communication services, more building on historically good performance. If you look at what's really gotten hurt, it's a lot of these over on the right side, which are more sort of defensive sectors for the most part. Consumer staples down 7% relative, utilities down almost 10% on a relative basis, real estate as well. And then you have two sort of frustrating ones: financials down to over 2%, healthcare down over 2.33%. Healthcare has been one of the more interesting sectors, and again, biotech has just emerged as this great long-term play, really strengthening during this last month or so. But healthcare as a sector not doing as well as some of these other sort of traditional offensive sectors. Let's look at these sector charts here very quickly. And if you look at these, this is looking at the last year on each of these 11 sectors. And the reason why I picked the last 3 weeks is if I noticed for a lot of these, everything sort of sold off in the first, last February to March, right? You can see across the board that was the case. All of them turned on a dime and had the V recovery, the V bottom that emerged. But over the last 3 weeks, you're starting to differentiate a little bit. Things that just continued higher in a position of strength: communication services, technology. What else? That might be it, to be honest with you. Maybe materials. Things that really started to turn down, things like real estate, utilities, financials, staples. Look at how, these both rallied and then discretionary continued higher, staples starting to come down. So you have this divergence where everything, rising tide lifts all boats in the first month after the bottom, 3 weeks after the bottom. And then the next 3 weeks, you're now starting to spread some of these sectors around, get a little bit more dispersion in returns, meaning you have opportunities to differentiate between what's working: communication services, technology, energy, really, continuing to strengthen, whereas things like staples, utilities, real estate sort of going down and to the right. And then you see things that are holding up on a price basis, not breaking down, but not really holding, not making higher highs. Healthcare and financials are the two that come to mind with that. So as we're thinking about these sectors, again, I think you've had the situation where stock picking has felt like a macro decision. You're either risk on or risk off. And I think what we've seen over the last 3 weeks is you're starting to see some differentiation. What stocks are really starting to work and which stocks are not. We're going to take a quick break. We're going to come back with our next segment where we'll pick out some individual stock themes building on what we learned from the sector rotation discussion. So we'll see you back in 1 minute. Hey everyone, welcome back to today's show, The Final Bar. Thanks for joining us every weekday after the close. We're going to have a mailbag segment tomorrow. Would love to answer your question on the air, so just shoot us an email, thefinalbar@stockcharts.com. We've gotten so many great questions from many of you, the viewers, over the last couple months, especially given the market volatility, the uncertainty, what sort of regime we're in, different particular charts, indicators. All of that is fair game. Just send us your questions. We'd love to talk through them together on the air, or just hit us up on Twitter @FinalBarSCTV. Tag us in a post, and we'll check that out as well. Our next segment, shifting stocks. So we've gone through now the top-down macro, just looking at some of the big picture themes. And again, Friday we really have a chance to dig into the macro themes a little more. So combine that with what we talked about with the recap this morning, earlier in the show, and then our sector rotation discussion just now was focusing on the leadership that we've seen in tech, consumer discretionary, communication services, and some of these sectors that are really starting to emerge. And what I wanted to do now is just pick on some of the themes that I found. Every weekend I go through the S&P 500 individual charts one by one and look for themes, and I jot down a ton of tickers that I think are at key points. I just want to highlight some of them. We'll start with Home Depot within consumer discretionary. Funny story about Home Depot. So I often, do a lot of educating. I do a lot of speaking, and I always, usually when I start talking, I want to have some chart up to start talking about the basic methodology that I use, or starting to learn from the lessons of history using technical analysis. And I always use Home Depot just because it's a sort of a decent example stock. It sort of has all the right characteristics. It gives you lots of movements. It gives you some interesting signals, and the relative strength has had stretches of outperformance and underperformance. But Former colleagues of mine always joke that I was basically the Home Depot analyst because that was the one that always came up. So it looked like I was always just pinpoint focused on it. Worth noting that it's making a new 12-month relative high again this week. So there, Home Depot doubters. But anyway, so within consumer discretionary, we'll start with Home Depot. There's some interesting charts that have come out of there, but within consumer, you actually have quite a bit of differentiation between stocks that are working and stocks that are not. So I feel like for every Home Depot, I could show you some other stocks that are maybe starting to break down a little bit. So let's look at some of the individual themes. Home Depot in particular, to be honest with you, I'm looking at, it's nearing an overbought condition as it reaches previous highs. A lot of, the S&P, other stocks are sort of down here trying to test their 200-day from below. Home Depot has already eclipsed that, and now the real question, right? The number one question for a chart like this is it able to eclipse the previous resistance levels? Here, we're trying to overtake its February highs. Within consumer, staying with that theme, next one will be Brown-Forman. We're going to jump around just a little bit with this within consumer here. Brown-Forman was in consumer staples. This is in the distillers and vintners group. What's funny is the chart actually doesn't look that dissimilar to what we just looked at. That's why it actually came to mind. Home Depot was maybe a little bit further on, sort of testing the February highs, but Brown-Forman isn't that far behind. If you look at the rest of staples, it's outperformed the rest of staples handily. Although compared to some other stocks, it hasn't been as dramatically positive. However, a stock making, teasing new relative highs, breaking through new swing highs within a sector that's struggling is actually pretty interesting. So that's Brown-Forman, BF/B. Back to consumer discretionary, and sorry for jumping around just a touch. We have TSCO, Tractor Supply Company. So again, I'm not necessarily a fan of buying the new highs list just because it's on the new highs list, but I am very interested to see a stock that has broken above a big base. So its February high is actually down here. It's already broken well above it, pulled back, and then resolved further to the upside. Relative strength making a new 10-month high this week. And the RSI is nearing that extreme overbought region. So again, now it's testing its peak from last July. But overall, definitely in a position of strength, and the relative performance has been consistently pretty strong. We're going to switch back now, consumer staples. We'll finish off some names here. So again, within consumer staples in particular, I think you have some haves and have-nots, and we're going to go through some of these. Conagra Groups maybe frightens me a little bit, only because it's tested previous resistance and pulled back. Again, if it's able to break above 35 and hold that, I think you have to buy into the sort of that new high story. But for now, I'm seeing a relative strength that's sort of tapering off a little bit, teasing a new 1-month relative low. And if that continues down, I think it potentially is one you want to think more of taking some off, because it's had a nice run and now unable to get above resistance. Now, within consumer staples, you have a couple charts that are actually emerging pretty decently, although the relative strength has not been dramatically positive. Campbell's Soup comes to mind as one of those. Had a big upswing. This is right in mid-March, which was right at the market low, so held up really nicely. That's where the relative strength spiked. Since then, it's really been more of a market performer since late March. But now it's starting to roll up a little bit, making a new closing high for the last month and also a new price high. The relative strength is still relatively flat because other sectors are doing okay, but I'm looking at that. And I'm looking at, General Mills, GIS. You can see a similar sort of pattern testing the new highs, relative strength flat, but again, in a sector that's struggling, holding up pretty well. Hormel is maybe a third one, pulling back to its 50-day, starting to roll up a little bit. So some of these charts aren't horrible, but again, the relative strength on all these just isn't my favorite. So, given all else being equal, I would much rather own stocks making good relative moves than anything else. Now, you also have some concerning charts in here. And again, there's a lot of earnings, a lot of things happening. Cody, COTY, just had a bearish engulfing pattern, although it's not ideal because you really want that after a big up run, but certainly testing a new relative low for the last year. So I think that's sort of an avoid, watch out sort of chart. Monster beverage to finish with the consumer staples. Again, there are stocks doing pretty well. It's making a new swing high, making a new relative high for the last month, and testing or approaching previous relative highs from the peak in March. I'm going to avoid energy because, to be honest with you, I think the charts all look relatively homogeneous. Schlumberger, SLB may be one of the better examples of that. Relative strength has been flat in this case, but sort of creating this ascending triangle pattern. If it's able to eclipse 18 and hold that, I think that could be really interesting. Until then, though, I think you have to be a little concerned. We're going to go through a couple financial stocks and then finish with tech. This segment always goes way more quickly than I want. But here we go. Franklin Resources benefits. So within financials, I will tell you my average reaction is because the relative strength has been abysmal for a lot of financial stocks, especially the large ones, which is why the sector looks relatively poor. But something like Ben is actually recovering kind of nicely, making higher highs, higher lows, just breaking to a new swing high today. Relative strength starting to turn higher. So if that continues to emerge, I think it's actually a fairly constructive chart. You compare that to something like BAC, which has tested its 50-day and failed to really hold above it. Relative strength testing a new 52-week low. That's why it looks a lot less attractive. So within financials, there are actually some haves and have-nots. In terms of other haves, I think if you look at some of the insurance names, like AIG is one that it's just starting to test resistance, see if it can eclipse it, see if the relative strength can hold. You also have, what were some other names I jotted down here? AIG, MMC, Marsh & McLellan. This is one that's actually broken above its 200 days. So something we're talking about for the S&P, is it able to eclipse its 200-day and hold it? MMC appears to start to be able to do that, which is pretty impressive. And then Willis Towers Watson is another one similar to Marsh & McLellan, breaking above that swing high from early April. So within financials, there are actually some stocks that are performing relatively decently. And if you want to know what's really the strength that's within this group of market access, MSCI, S&P Global, these sort of index provider names, I tend to think of them as all making decent relative highs. So relative to the rest of financials, absolutely crushing it. We don't have enough time, unfortunately, to go through too many more names. So we're going to come back, I think, to a couple of these later in the week. We'll dig into them a little further. We need to move on to the 3 and 3 charts in 3 minutes. And here we go. I hope you guys enjoy the show. I have so much fun putting these charts together. I feel like we tease so many of these themes, and I hope it inspires you to dig deeper on many of those, especially when we look at individual stocks today. Chart number 1 on their 3 and 3 today is looking at breadth in the form of stocks above their 50-day and stocks above their 200-day. It's the 200-day here in blue. It's the 50-day in green. I highlighted this last week because it had spiked up to almost 80% of the S&P above its 50-day. That's up from 0 in late March. Came back down to almost 50%. So 20% of S&P names had gone above their 50-day and then back below, essentially. Now we're right back up to the previous swing high. So just like that, you see a lot of stocks right at their 50-day moving average, sort of right at fluctuating. This is what happens with a lot of breadth indicators. You will get huge swings when we're right at that key pivotal point, and I think that's where we're at. So the volatility in this indicator tells me we are certainly at that sort of line in the sand, that point of no return. Are we able to continue this next leg higher? Are stocks able to remain strong? Right now, 3 out of 4 stocks above their 50-day, or do we continue and do this next leg down, as many of my guests have said? And again, over under a third of S&P stocks have reclaimed their 200-day. So while a number of them have gone back above their 50-day, most still remain in a downtrend in terms of relative to their 200-day. Chart number 2, we talked a lot about sector rotation. We looked at some of the sector themes over the last couple of weeks, and I wanted to point out this chart, which I think tells the story of healthcare really well. If you just look at the price of healthcare, it seems very constructive. It had a nice rally, nice outperformance, has sort of had a choppy last couple weeks to a month. And again, the question is it able to regain that? And if you look at the individual charts, especially with biotech and how strong they've been overall, I would assume that that's going to continue higher. That's a fair guess. But if you look at the relative strength, this is relative to the S&P 500, starting to turn down on a relative basis over the last 3 to 4 weeks. If you look at it relative to healthcare, that's the real killer. Whereas tech has emerged now and regained, I think, that number 1 sector status from healthcare. Chart number 3 then is the chart of the XLK, and we talked about how the sort of led in the downturn, led in the initial V bottom out of the lows, and then sort of stabilized. And then you had this situation where the S&P was going higher here, but the tech sector was actually just flat to down a little bit over that 3 to 4 week period. That has now completely resolved to the upside. So some of those tech safety names, things like Apple and Microsoft and so many others, even semiconductors, holding up very, very well and continuing to outperform, even as investors are scratching their head trying to figure out what's potentially coming next for stocks as a whole. Folks, that's our show for today. Thank you so much for joining us every weekday after the close for the final bar. Again, my goal with this show is to empower you to make your own decisions better. So I hope the charts that we look at together inspire you to dig deeper with your own StockCharts account. If you have any questions, shoot them to us via email, thefinalbar@stockcharts.com, or just check us out on Twitter @finalbarsctv. All of our previous episodes on our YouTube channel. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.